Electronics and Tech Expo. And so they stream straight out of they like do that in Dubai and bring like the rest of the world in, spend a lot of money on it. So it's
amazing.
Yeah, quite cool. Yeah. And Marvin, you had like a really funny tweet, which was like, man, if we could actually return some funds with all the money that African VC spends on
conferences.
Yeah.
Unbelievable. Probably, man. I did some quick maths. It's incredible. We'd probably return a few funds, but I guess, they're necessary. I think Henry's put it well, where we're very scattered, 54 countries plus. So gathering is not a bad thing. Henry, I think the main ones are Africa Tech Summit in January, this Morocco one now, and then at the end of the year, Cape Town. So there's 3 like focal events in different locations. So next year we'll make sure you're attending some of those if your schedule allows.
Amazing. I don't know, Caleb, I think we might be live now.
Yeah, we are. Yeah, we try to do like a rolling start where we just chat and as people sign in. But yeah, fantastic. All right, so to everyone tuning in, we're going to give it a couple minutes. It's good to see a few people already here. People on the stream, so people in the comments, just say hello. I'd love to hear from everyone tuning in, like, who are you firstly? And, are you running a startup that manages equity, yes or no? And then if you want to, one thing you want to learn from this session in talking about Africa's innovation ecosystem and liquidity. So feel free to put that in there. As we wait for Marvin to come back. Awesome. I see Goodman in the chat. Good to see you here. Dr. Chris Brooks here. Simon Marithi. If anyone else is here, just like comment in the LinkedIn comments and say, who you are, if you're running a company, and then if if you're managing equity at the moment. Cool. Let's do a quick round of intros as people sort of file in. Welcome back, Marvin.
Welcome back. Yeah, thanks, man.
We have with us Marvin Colby, the CEO of Raise Africa, frequent collaborator. We love Raise. They'll tell us a bit about what they do soon. And we're also really lucky to have Henry Ward with us, who's the CEO and founder of Carta, massive cap table management company, market leader, calling in from the US, from SF. Super excited for this session. Maybe we can get into it and get started. Maybe I'll hand over to Henry to give us a quick intro to yourself, what Carta does, and then after that we'll do a quick, Marvin will also do an intro, and then we'll come back to Henry for the story of Carta.
Yeah, hi everybody. So excited to be here. Welcome. My name's Henry Ward. I'm the co-founder CEO at Carta. We do cap table. We do really two lines of business: cap table management for startups. That's about 2/3 of our business, and then the other third is what we call fund accounting for venture funds. So if you think of like the cap table is the ledger of all the shareholders of a startup. What's called the general accounting for the fund is the ledger of all the LPs or the investors of the funds. So if you think of, we're a shareholder management tool. We manage the shareholders of the startup, and then we also manage the shareholders of the venture funds. And those are our 2 lines of business.
Nice. I think we often forget that funds have to fundraise too, and there's so much complex like accounting and sort of like management to do there as well. So could have that background. Marvin, over to you.
Yeah, man. Raise. Thanks, Henry. We're part of Raise. Raise.Africa is the name people know us as. Do very much the same thing, focus on cap tables. That's currently 100% of our business within the African context. And everyone on this call knows that the typical African corporate structure is relatively complex. So that ledger of shareholders is spread across multiple jurisdictions, even at a seed stage. And so we help kind of collapse that corporate stack, help with the shareholding, cap table management, a lot of that stuff within the African context. And so we see a lot of stuff because we're still a very early ecosystem. And so building very much from the ground up. And one of the issues we're having as an ecosystem, Caleb and Henry will be talking about today, is this liquidity deficit, this liquidity crisis that we got going on. And a big part of solving that is having a ledger. And that's a big reason why Raise exists today, is to create that ledger. We can't solve this without a database.
Super cool. It's awesome to have like, really the kind of like US and market leader Carta here, but then also like the version of that, but for the continent, and to see like the differences and what Africa needs that's different to, like just Carta. And so I'm keen to also unpack that a bit and talk about this liquidity crisis, as we've termed it, Marvin. But let's go back to Henry. Henry, I'd love to hear a bit about, how you started. Maybe tell us about life before Carta. Like, what were you doing before you started Carta, and then how'd you stumble on cap tables?
Yeah, I'm certainly an accidental entrepreneur. So I, previous life, I went to University of Michigan, and then I moved to Texas, and I was in enterprise software for 8 or 9 years. And then I moved to France for a couple of years for grad school, and did a little bit of finance in Paris. And then my, at the time, fiance, now ex-wife, had gotten her job in Palo Alto. So we moved to Palo Alto from Paris. And I was I didn't have a job. I didn't know anybody. And it was one of those things, I guess, if you were, had taken drama class in high school and your fiance moves to Hollywood, you might audition just for fun, just to see what it's like to be an actor. So I was a hacker, engineer. And I thought, well, maybe I'll start a company, because that's what everybody did in 2010, Mountain View. So I joined the hacker, clubs, and just got to meet other founders all working on cool things. And I got immersed in it. And I started a company that was like a robo-advisor, that was like a Wealthfront or a Betterment, if you've heard of those in the United States. But I did a terrible job. The founders of those two companies, I know Andy and Josh, and they did a way better job than I did. And they became big companies. Mine failed. And after I wound down that company, I sort of went through that trough of depression. But I couldn't imagine doing anything else. Even as a failed founder, I fell in love with just being a founder. Everything you do matters. You only eat what you kill. There's no A for effort. The only thing that matters is the market. You can't suck up to a boss. It's just, I fell in love with that lifestyle. And so I was looking for an idea. I was an entrepreneur without an idea, and which is non-conventional. Usually what they'll say is, you should find it, you don't want to be an entrepreneur. You just are in love with this idea. And then you become an entrepreneur because of the passion of the idea. I was backwards. I was in love with being an entrepreneur, and I didn't care what idea I worked on. And one of the investors I was working with on my previous company said, hey, this cap table problem is really painful. You should take a look at it. And if you start, the company will, I'll invest in it. And so suddenly I had an idea, and that's how at the time eShares, and now Carta started.
I love that. I love the very of the times name, eShares. It's like you put an E in front of it, and then it's internet.
Well, that's exactly right. And the original idea was, it was just electronic shares. It wasn't even a cap table company. The original idea was just get rid of the paper stock certificates. We're just going to do electronic. Our competition was FedEx. It was, don't mail a paper stock certificate, just email a paper stock certificate. And that was our value proposition. And that turned into cap tables, which turned into 49A, which turned into expense accounting, which turned into fund accounting, which turned to, it just kept building on top of that very small atomic unit of value that we created.
Mm-hmm. Yeah, super cool. I guess like just thinking about that side where you stumbled on a problem, you were an entrepreneur looking for something to solve and build around. What was that process like? Like when you're looking for something, like because I know that there's a lot of entrepreneurs who want to do that. They also have had a taste of that lifestyle. They might have had a business themselves. They might have failed before, and they're like, we want to try again and find something that's uniquely ours. But how did you search for that problem and like try to uncover that market?
Yeah, it's such a great question. And, ideas come from so many different places, and it's hard to have a playbook or a cookbook on it, because if it was an easily repeatable process, then anybody could do it. right? And so almost by definition, startup ideas are an aberration. They're an outlier. And so if you create a way to systematically create startups, then you wouldn't need entrepreneurs and you wouldn't have outsized outcomes. So it's very hard to create a repeatable playbook on them. But I think there's a few frameworks that help, and it all depends on the industry and the entrepreneur and the type of idea. So I would say, for example, like I'm not a consumer person at all. I don't understand consumer behavior. I don't understand why some things work and others don't. I remember Peloton early, and we called to be a customer, and the CEO was like explaining the business to me, and I'm like, it's a bicycle that doesn't go anywhere with an iPad, strapped to it. I don't get it. Yeah. So it's like, but in my world, one of the frameworks when we think about ideas here is anything that humans do that we think we can move into the cloud is signal that there's something discoverable there, right? When we see, wow, humans spend a lot of time doing this, as that is, some things can't really move to the cloud, right? It's like harder to do, cleaning or furniture, assembly, right? That's hard to move into the cloud. But things like spreadsheet work, right? Whenever we see a lot of people spending a lot of time in spreadsheets, we're like, wow, that looks interesting. And it's the same kind of work that they do over and over. So we look at that and we're like, oh, that's signal. When we see people doing spreadsheet work that can be moved into the cloud, and then it's multiple people, right, all working on the same spreadsheet, then we're like, oh, there's network effect in this. And so there's like these frameworks and signals that we have that we say, oh, that's a really interesting idea. So if you look at, like, for example, 49A, which is our second product after we did cap tables, we got into that because it hit all these criteria. We're like, oh, people are taking our cap table, they're loading it into a spreadsheet. A bunch of people are doing math on it, manipulating the spreadsheet, and then sending the spreadsheet back for review, who do some more math, and the spreadsheet back, and there's all this workflow attached around this 49A. Could we just put this in the cloud? And then that was our 49A product. Expense accounting, same thing, spreadsheet being passed around. Can we just put it in the cloud? Fund accounting, it's a bigger spreadsheet. It's actually a set of spreadsheets. It's a more complex problem, but ultimately it's just a bunch of spreadsheets being passed around in a workflow. And so I would say that our sort of, the thing that we do really well is we look at problems where this combination of spreadsheets and math plus workflow to create systems of records, that's our heat-seeking missile to like go look for those types of problems, and then deeply understand how the state of the world works today, and then how do we map that into a better world in the cloud, and that's the playbook we just do over and over again.
That's really interesting. I want to ask one more question about this before we get back into the journey. But so before I started Tech Safari, my last company was an ed tech called Entry Level, and it taught people to get into tech jobs in 30 days online. But the way we started was we actually raised money first. So off the strength of the founders, we raised some capital to get started. 2021, very different time to today, right? Money was playing. But we didn't know what we were doing. We just knew it would be something in recruitment and ed tech and the merger between the two. And so the way we discovered that product was we just tested, and we had a different test every week. The way that you just explained how you found out this problem was through actually just thinking what can move to the cloud. And it sounds like almost kind of analytical, like the thinking side of understanding a problem. How did you start it off though? Was it a lot of thinking and sitting in a room and just mapping out what can go in the cloud, or was it testing rapidly as well? What was that initial process like?
It's such a great question, Caleb. And there's sort of two again, everything's a little bit in the middle, but for the thought experiment, I'll give you the two ends of the spectrum. So there's some product managers and founders that are you learn via experiments, you learn from your users, and product management and startups is, it's kind of the lean startup way, which is, you really quickly iterate on what the market wants. And the product and startup development is really it's a problem solve or solution solving algorithm, right? Like an Excel macro, And then the other side, and this is sort of the Steve Jobs version, which is like, you never do a focus group, right? You have to have a product vision that comes from the founder, and people adapt to your vision, right? And the reality is it's all somewhere in the middle. What I tend to push our founders that I work with and our product managers here at Carta is to separate the two, where the what should be on the far end of a product vision, and then the how is on the far end of the experimentation. And so what I mean by that is like a true good product has to have a real product vision that you can't get from users. If you could iterate your way through users, then the founder has no competitive edge, right? The best company would be a big company that can just ask users fast enough what to do, and then they would just solution solve into the solution better. So that's why startups exist, is because founders have a view of the world and a vision for what the product should be that nobody else has, and that you can't interview your way into. So they should have a clear, crystallized view of, for us, it was like, we're going to build a cap table that takes workflow in, issues a stock certificate, builds the cap table that multiple people can look into, and that the investor gets a certificate. That was our product vision. We believed in that. And at the time, nobody else believed in that. Nobody saw what we saw that could be. But then the question is, okay, well, how do you get there? And that was very iterative, right? We brought paralegals in, and we're like, how do you do that work, right? Oh, show me this, try this, click this button, what happened, right? That how becomes super, super iterative, because the how is where you get the velocity of product development. What many people make the mistake on is they try to get the product vision from the customer. And customers do this, classically are very good at explaining their problems, very bad at giving you solutions. And so what happens is the product managers that just get the product vision from customers is, instead of building a product, they build a collection of features. And those are the products that people hate most, right? Because they're not cohesive. They're just a collection of things that people ask for, because there was no clear vision that the product manager had.
That's really cool. I like that, like, comparison between kind of like the what and the how. And the what is like vision led. It's like, that is the analytical side. It's like, what do we envision the world looks like? And then how do we get there, is what are the sort of tests we run? Really cool insight. Okay. And, today Carta has raised over $1 billion, valuation north of 7 billion. It's like, it's come a very long way from eShares and that first customer. Was it kind of smooth sailing from there, or like, what has that sort of journey been? I know it's a multi-year journey, right? But like, what has that been since you started through till today?
I remember, so it's May, almost June. We started 10 and a half years ago. January 2014 was when we opened the doors for business. Made $120. Our first customer, I think it was January 17th. It was a startup out of Austin, Texas, that paid us. As a guy named Kyle Samani. He's now an investor, but I remember he called and said, I'm going to buy your software. And I said, great. Can you call me when you run your credit card? Because we just did this integration with a new company called Stripe, and we don't know if it's going to work when you pay us. And it's great. I'll tell you, so we charged them $120. I think that month in January 2017, we made $700. We're about 12 employees. Fast forward to 10 years later, 10 years and 4 months, we're 2,000 employees, about 400 million in revenue. So that's like what it sounds like, great on the outside. On the inside, we're a startup. It's a mess. It's a roller coaster. Everything's always broken. Nothing works right. It's still hard and miserable. It's the same problems. I think, I used to think when I was an early stage founder, like, when you're 100 employees, you've made it and it's smooth sailing. And you're, 500 employees, you've made it and it's smooth sailing. And you're 1,000 employees. I tell you, we're 2,000 employees. It's not smooth sailing. I don't feel like we made it. It's the same problems. It's people problems, customer problems, product problems. The door broke in the office, and now we can't get it through the elevator, and it's just the same stuff you deal with. It's just at a bigger scale, and so it never changes. It's always a grind.
Thank you for that deep insight. That's really cool, and it's very encouraging as well. I think there's a lot of founders that are earlier in their journey, and it's cool to like hear it's not all the best at the top. It's like it's tough the whole way around, but you can build really incredible things. Marvin, I'd love to sort of go to you and hear a little bit about how did you get inspired to build Raise? What was the thinking behind it, and and like what was the thinking behind it, and how much of it was that kind of the heavy thinking versus like the quick testing and trying to understand, what users wanted?
Definitely, man. There's no quick testing in cap table software, and Henry knows this better than anyone in the world. One small mistake and everyone is on your back, but you could do it right 50,000 times and no one's going to give you an A for effort, like he said. So Raise has been shipping software, products, services, a lot of people on the call know it, for 6.5 years. Over 80% of our revenue came in the last 6 months. And a lot of it was just like panel beating. Yeah, I know. Thanks, Henry. It doesn't get easier. We're really, that was super encouraging. Thank you. But the vision has stayed exactly the same. I was actually looking at our white paper in 2017 versus now. It's always been the same thing. It was like, we need to build securities infrastructure to build healthy capital markets across Africa, similar to how Flutterwave or Stripe would build or Paystack would build infrastructure for payments and moving money. The vision for this has always been the same. This is infrastructure for moving capital instruments, equity, debt, bonds, securities, indexes, everything. We figured if there was a shot of doing that, then we could drive a lot of economic development in Africa's capital markets where we finance our own growth. As Caleb, you know as well as I do, a lot of capital still up until recently came from outside, which is cool, but it limits our options here. We end up being price takers in deals instead of setting prices on term sheets. And so vision's always been the same. How can we upgrade the foundation of Africa's capital markets with reliability, liquidity, efficiency, all of those things? And this actually existed before we found out about Carta. So I actually remember the day that we found out about Carta for the first time. And anybody who's been to Nairobi knows Grenier Pan in Riverside. It was at that restaurant that myself and our founding engineer looked at Carta for the first time. I was like, whoa, we're not the only people to think about this. And at the time, Pulley, et cetera, didn't exist. It was really just Carta. This was like 2017, 2018. And we figured if we had a shot at liquidity, it had to be made up of two things. One, a database of equity. You got to do cap tables if you want to figure out liquidity. Is kind of, you can't allow people to trade things if there's no database to discover the price. So that was the first set of things we needed to do, but not the fun thing, because that's a SaaS product. The second thing we knew we needed to do is when you look at the capital structure of stock exchanges, private markets in Africa in general, the liquidity is just so skewed and relatively low compared to the economic opportunity and size of the African continent. And the background we come from is from the decentralized financial space and crypto and that whole world. That is the background we come from, and that is the genesis of Raise. So the second thing we knew is, well, very strong hypothesis and chance when Henry spoke about a product vision that much of Africa's on African continent trading volume, capital markets activity is probably going to be on-chain. And that's probably the only hypothesis I've been unable to disprove for 6.5 years straight. Everything else has been disproved. And so that was the founding genesis of Raise, man. Stayed the same, always to build healthy capital markets with securities infrastructure. Took a long time to get to where we are now. So that database, we still have a long way to go to build equity. I think, Caleb, the reason a lot of our traction has come in the last 6 months is because while capital was readily available, no one was thinking too deeply about their cap tables so much. And since most of it was safes and had valuation caps, everybody had markups and everybody was comfortable with the situation. Until very recently. We have a very low volume of stock options that exist in general for a bunch of different reasons. And we still probably have a huge saturation of convertible instruments versus price shares, which means it's not an accurate mechanism for pricing ownership in an African startup. There's only been a few Series A deals in general. So yeah, I wouldn't call it a crisis because, I call it that because we just want to create that urgency. But we definitely got some underlying issues that I think we've already seen the comments that everybody has posted about. We're all aware, and our role here is to present and act and ship solutions.
Interesting. And yeah, thanks for that, Marvin. Awesome to get the rundown and see how it's tied to just like the economic growth of our continent. So it's cool to see that vision as well. I want to dive into that. This is a really good segue, Marvin. And I think you made a great point. You, as a cap table management tool, you get incredible data on, what is the state of equity across a region or across a space. And I wanted to sort of double click on that. We did use a lot of like terms in there that I want us to like unpack, probably in a more plain English way for our audience here. But what is the state of equity in Africa? Like, tell us a bit about the data. Like, what has been raised and what has been exited? Has what's been raised kind of like lived up to, or that equity lived up to, what a healthy startup ecosystem or exit market looks like?
Yeah. Good question. In terms of data, we're still very much learning because we're very early on in the journey. And most of what we do today, we learn from Henry and Carta, but their database is incredibly large, right? Ours is still relatively small given cap tables across the globe, but an African market is getting bigger and bigger since the ecosystem is relatively small. And I would say there's kind of three things we've seen as trends that are issues in this ecosystem that I think we're all facing. Those are the following three things. The first is a liquidity deficit. And what that means is that there's a deficit in the amount of distributed to paid in capital that funds have put in, or LPs have put into those funds. And there's a lot of markups because there's a lot of safes. That's the first thing. Second thing is there's not the best price discovery. So valuations across our ecosystem, when funds or angel syndicates or startups are pricing the equity of the company, it doesn't really always take into account the local benchmarks that we have, because there's no robust data set around that. Two deals will happen at the same month in isolation of each other in our ecosystem, right? You'll have a deal closing in Morocco and Kenya at the same time, but they're not using, in the same industry, but I bet you, and I can guarantee you're not using the same analysis to come to a valuation of that company. So price discovery is kind of skewed across the ecosystem. And the third thing is that because we end up choosing all these different holding entities across the world, Delaware, UK, Mauritius, now Dubai, our capital structures are a lot more complicated than they probably need to be. You'll have a seed stage company with we have a customer we onboarded last week that has 7 subsidiaries and 2 holding entities. This is a seed stage company. Their revenue is like 20K a month. They have to now manage 8 entities in total. So when you take the collection of those 3 different things, a liquidity deficit, not enough capital to return based on how much has been invested, which is about $22, $23 billion to date. Second is a poor price discovery in terms of how we value companies. And I think that's changing now because we have more funds that are taking up and leading deals, which is very important development. And third thing is capital structures of cap tables and corporate structures in Africa are just generally complicated at the technology phase. And the kind of the collection of those 3 things is what is creating this perfect storm. When you add on the inflation we're all facing, right, on the currencies, the revenue depreciation against the US dollar and the valuation caps that are too high. You add on the different security laws across these jurisdictions and the startup acts that are very different. A company now, a typical seed stage startup now has to not focus on just getting to product market fit. They have to run a late stage company at a very early stage. And only until recently companies really understood the importance of structuring that stuff into one place or using software. And a lot of it is being pushed on by the funds. So last thing is the major development. Caleb, you know this data as well as I do. Back in the day, like 2 years ago, many funds in our ecosystem would follow deals. The Tigers, the Sequoias would come in, set the price, we would follow. Over the last couple of months, much bigger percentage, I think we're 25% of the deals that are happening are led by African funds. So funds that have raised LP money from anywhere, but their team is based on African continent. They have a very specific Africa thesis. And we've seen a lot of the term sheets lately coming from those funds, and they're very high quality, world-class term sheets going into very high quality African startups, And so that development is probably the most optimistic I think I've been as of late. And I think we all need to hear that, is that stat that we have local capital finally leading deals, which means we're aligned philosophically with the growth of the African continent. And now we're aligning the price of those equities in line with that economic opportunity in Africa, And so you take that trend and you multiply that over the next 10 years, the next, $30 billion worth of financing. It's kind of what I've referred to as the next generation of startups in Africa and capital markets that is looking a lot better because we had this price correction. It was very necessary, I think, in the ecosystem, Caleb. I think we lost Henry for a second. But that's kind of the three main things in the data we could dive into.
That's really interesting. I want to just clarify something. So did you say price discovery? It sounds like that is when you look at you're a fund or you're a founder even, and you look at like other companies in your space and you try to understand what are they valued at, what are their fundamentals and why. Like, tell us a bit more about that. Is that common? This is the first time I've heard about this idea of like price discovery.
Yeah, price discovery is the efficiency by which you enter and exit an asset, right? So let's say right now you bought one common share on the Johannesburg Stock Exchange, right? You know the price, you can buy it right now, you can exit it in a few seconds. That is an incredibly high level of efficiency and quality of price discovery because we standardize the common shares, we standardize the economic and governance rules around those common shares, and we standardize the price, right? So you know you're buying one common share for R1, you can sell it at 1.2 Rand. You know that's always going to happen. By definition, startups in general, the venture asset class is a poor price discovery space, right? Because you could enter an asset, you kind of have a sense of, my valuation cap, right? And then that valuation cap turns into equity. You kind of have a sense for earlier stage companies, later stage companies you do, but you have no idea when you're going to exit that asset class. You could hold it for 10 plus years, like many funds would project out, right? And so by definition, it has a very illiquid price discovery. I think if you look at our ecosystem in our context, right, it has an especially inefficient, poor price discovery. So let's say Texafire, I'm investing in Texafire as an example, right? You grew to X amount of users. Let's say you're like headquartered in Kenya, I think, right? And we take the same company in South Africa and did the same exercise. This happens in African tech all of the time. Same industries, same growth rates, call it like 50% per month. And I invest in both companies at the same time. I guarantee you, many times we see different valuations for the same companies with the same growth rates in different places. Or you get situations like a company we're working with right now who we love, who is very close to break even. Their revenue is incredibly predictable. They make the revenue of a Series B company would make, but they're being valued at like kind of a Series A company, Whereas if you took that same company and put it in Silicon Valley, it would be valued at a huge 15x plus premium. In our ecosystem, they get 3x max. And so I say that because there's all these different examples and probably a lot more of like this really inefficient price discovery that exists in this ecosystem. And that's probably one of our biggest challenges, We're not pricing correctly in the African tech ecosystem. That's what poor price discovery is.
Yeah, interesting. Thanks for unpacking that concept. That's like a very interesting one. What about exits? How are investors getting their money back? You had a very interesting tweet, which was that we should be more panicked as an ecosystem. There's not enough secondaries, IPOs, M&A activity to satisfy the liquidity deficit we have in African VC. That's a really interesting one. I think you can count the number of like exits that have been worth over $10 million on two hands in the last 5 years, right? Tech exits. There's not that many. And so and there haven't been that many companies who've gone public either since really Jumia. And so what should we be expecting? Where is the state of exits and liquidity right now? And what should we be worried about when it comes to this?
Well, maybe what we should be worried about, right, is that there might not be enough returns on IPOs, secondaries, and M&As in the short term to kind of satisfy returns for LPs, right? We have to make sure LPs are seeing potential in this asset class and continue investing, It's kind of like two lenses to look at the African tech ecosystem. There's startups building stuff, and then there's the venture asset class, right? If you look at it purely as a venture asset class, the returns that we need to return are billions of dollars, right? And that's just not happening. And so the three solutions we typically always look at in the ecosystem, or just venture asset classes in general, is initial public offerings, mergers and acquisitions, and secondaries. Let's start from the back, right? The secondaries to be a viable option, the valuation multiples on their revenue needs to be relatively high, right? Because that Series A, you need to clear the price. Hey, Henry, welcome back. We're just talking about no problem, man. We're talking about, we're kind of breaking down why it might be tough to figure out liquidity in this ecosystem by looking at IPOs, M&As, and secondaries, right? And so we're working backwards. For secondaries, Caleb, to be viable, again, we have to return right now, today, billions of dollars worth of capital, right? Today. Secondaries, for that to be viable, you need huge revenue multiples on companies raising Series A's from safes and Series B's, et cetera. We don't have a ton of Series B, C companies. We already know the growth capital is relatively limited from the inside. So that is tough because over the last 2 months, we've only seen max like 8x revenue multiples, and the secondary is very small. So you could even scale that, assuming we would have more Series A companies, probably not viable. M&As, I think we've seen quite a few of them, and when they get announced, they have really nice stories. They really, really do. Like very often, those are common share swaps, right? So there's no cash that's actually leaving hands. The stories look nice and a very important consolidation of software and product visions, like Henry said, but there's not enough cash changing hands on M&As outside of South Africa to justify huge billion-dollar returns, right? And the only solution we got left is initial public offerings, and the Johannesburg Stock Exchange, Nairobi, Egypt, they list maybe 10 to 12 companies a year, and the bar is crazy high, right? Most companies in our ecosystem don't make their revenue, won't make it anytime soon. And even if they listed, they'd be listed as shares in the local currency, which is not fun, right? You would have to return X amount more money in Egyptian pound or Kenyan shilling and Nigerian naira to return the dollar multiple. So 3 of those solutions are incredibly limited for where we are now. And really at least for me, really challenging to see how we kind of like fill that gap over the next 24 months, you know? And so it leaves the question of what's going to happen, right? Because we have a lot of funds that are depending on subsequent funds. They have huge markups. We need to figure out what to do. And this isn't a problem that's reserved to anybody in particular, no particular startup or fund or law firm. This is a common problem that I think is like, if we don't figure this out, to your earlier question, it'll be really hard to defend the African venture asset class as a profitable industry. That is especially problematic today, given that venture capital in the last 3 years now accounts for a majority of private market deals. So we're no longer talking about like a technology industry anymore. We're talking about Africa's private markets depend on us figuring out this liquidity deficit.
Mm. And I think like broadly and you know, very important to this audience and like to the sort of tech safari community and really just generally our African tech communities, if we don't like show returns, you know, the TLDR is like, if we don't show returns and get liquidity, we're gonna have less and less investors coming back, less LPs investing in local funds. But I think, and honestly, like partly like more concerningly is less global funds wanting to take the plunge here. And I think that's really been key to our Series A, Series B's growth stage funds. You almost always have to look outside of the continent to do that well, especially if you want to scale and you're thinking with like, you know, large scale exits in mind. And so that to me is quite concerning. And I think we've actually seen a lot less fund activity, international fund activity in Africa in the last few years, especially after Tiger Global, SoftBank have kind of disappeared. So there's already this big hole. And I think just seeing that, you know, we're kind of on the brink with these exits is a bit worrying. I want to go to Henry. Add to that, Marvin. Do you want to add some more to that?
Oh, it's just same with Henry. The opposite is also true, right? Like if we don't, it kind of goes both ways. If we don't fix this, this is going to suck for everybody. But if we do fix this, we just move a lot faster. So Henry, maybe you could give us a sense in the US and emerging markets, like what happens when an ecosystem is liquid, there's good price discovery, founders have capital, they become angels. Like what does that flywheel effect look like? Because we definitely need this optimism.
Yeah, so you know, when prices are going up and to the right and you get that liquidity flywheel, it's great, right? Because the investors invest, you know, they get liquidity, they get to reinvest, and that thing, you know, continues to create more companies and so on. And you know, venture is very much more so than any asset class a feast and famine, because there's the asset allocators. It's the last one that everyone puts money into, and then the first one they pull money out of. So it's the tail end of the whip of capital allocation. But it also kind of makes sense from a deployment perspective, which is, there is a limited number of amazing, founders and ideas out there at a given point in time, particularly if you think about like the technology innovation cycle. I mean, most of these, kind of periods of rapid growth followed some large technology innovation. So, in 1990, in the late 90s, right, it was just the internet came out, and that created a whole wave of amazing tech companies. And then I would argue the last decade, or the 2010s, was really about the iPhone, and mobility. And so that just created a whole new wave of, the Ubers of the world, and then on the back of that was the cloud. So once you had cloud, all these cloud compute companies, like, we're a beneficiary of that. Once you could start moving software into the cloud, created all these new B2B SaaS applications. And then, there's like hardware, with all these IoT type, personal device products, whether it's like, Aura rings or Pelotons, and so there's like these macro technical unlocks have created waves. So then everybody piles in, but there's a finite number of ideas and companies and founders that can take advantage of that new technology. Prices come in, returns go down money comes in, returns go down because there's more money for a finite supply of ideas and founders. Returns go down. People go, oh, that's not a good investment anymore. They pull capital out. Now there's not enough capital, because everybody goes, that's oversaturated. New technology advances, and so it's a very feast and famine industry. Unfortunately, like one way to think about it is, how do we normalize it a little bit? How do we make less volatility in the asset class itself? On the liquidity side, we have this problem in the United States for sure. We obviously have more robust capital markets, but I see this problem in Singapore, in Southeast Asia, and the Middle East. And what I've been talking a lot about, it's starting to develop here, where there's a middle market for private equity to come in and start buying, mid-stage venture-backed companies that will not be, public candidates, but are still solid businesses. Because what happens is, in the United States, you might get, $100 million a year revenue business growing 20, 30%. It's not going to go public. The public markets here, you need to be, 500 million minimum in revenue, and growing 30%, at scale, minimum, to be a public contender. And that's a pretty high bar. Not many companies are going to get there. But there's a lot of great companies that are, couple hundred million, that are good, solid companies. But even as mature a market, strategic acquisition market as the United States is, there's not that many strategic acquirers that can buy $100, $200 million businesses, right? It's a pretty finite market as well. And that's where these financial sponsors, I think, can really come and play a big role, which is they can, the Thoma Bravos of the world, the KKRs, the Audexes, the Cerebruses can come in and buy, these, call it sort of, $500 million to $3 billion market cap companies, professionalize them and turn them into great, solid, independent, businesses that generate cash. There's this view that in venture, it's like all or nothing, which is kind of true for venture, right? It's that is the business model. You find a founder, you get a great product, you hope for, zero or a lot, right? But a lot, is relative, right? $100, $200 million revenue is a lot, if you've only raised, $20 million or even $50 million. If you raise $1 billion, it's not a lot. It's, and so I think, when I look at like Singapore as an example, when I talk to the government there, what I tell them to solve liquidity, because they have the same problem. Not that many companies are going to get to the scale to go public. Even if they go public, they go on the Singapore Stock Exchange. That's not a very liquid market for tech companies. Like no tech company wants to go on SGX. They'd rather go to the US. It's really hard to get to scale to list on in the US or even London. And so it's very hard for them. But if they had a mature in Singapore, if you get to 50 million, 20 to 50 million bucks, that's a pretty good outcome if you've raised 10 to 20 million. And if you had a mature mid-market financial sponsor industry that could come in, take these founder-led companies, 20 to 50 million, professionalize them and turn them into cash flowing businesses. I think that's the answer for these ecosystems. And you're already seeing in the United States, Lightspeed as an example, just raised a fund specifically to go pick up companies in that type of market or that segment.
That's very cool. That sounds like very fun work as well. I think that, so I like this because we're now talking about different options, right? Different options to liquidity. And Africa is almost like liquidity crisis. And just to add to that point, Henry, and to riff off this, I think that there's, in addition to buying companies that are doing well and, at a certain like run rate with revenue and could just be professionalized and bought out, I think that there's, one of the unique things we were talking about earlier is that across Africa, every geography is very different. Every country is very different. And within countries, it's very different. So you might have a fintech company that's doing okay in doing really well in Nigeria, and a completely different one in Morocco doing the same thing or very, very similar services or tech stack. But it's just contextualized. And so I think that in addition to this opportunity to just buy a company, I think there's a big opportunity to consolidate companies that are across different geographies and sort of share resources. And one good example of that is we had our biggest merger in African tech at the end of last year with MaxAB, which is a B2B retail company, and with Soko. Both have raised a lot of capital. Both have now sort of put together their core team, core functions, core resources to consolidate. And we actually did a session yesterday at GITEX talking about what that looked like and what the future looks like. And one of the options is actually more consolidation. How do you bring more people into the family to get the best talent, best resources, and best sort of skills on board to solve these really hard problems? And so I think another thing is, which companies are in a position to consolidate, and which companies can be like, hey, why don't we get everyone in this region to sort of come together? Is a potential for how we sort of meet this sort of liquidity issue that we have.
100%. And I think not to double down on my point, but to add to yours, which is that's in fact the private equity playbook for many of them, which is merge companies together, right? They financially back the consolidation of companies to find cost savings, reach, economies of scale, etc. Doing mergers, one-on-one is doable. It's hard to do. When we think about doing large scale acquisitions here in the United States, even for us, the first people I call is the private equity people. And I'm like, hey, if we're thinking about a really big transaction or idea, we usually want to partner with a financial sponsor that can help finance it. And so if you have a robust private equity, mid-market private equity ecosystem, they're the experts that can help both finance a lot of these mergers, but also bring in the expertise for how to execute once the merger is done. Because doing a good merger is actually really hard and takes work.
Totally. Awesome. Marvin, what else do you think we can do? What other alternatives do you think we have, or Henry, to just IPOs or exits or mergers?
The private equity one is a great one, Henry. That's actually been happening more often recently in South Africa and a couple other countries. I suspect it's because venture now accounts as a significant asset class for private deals in general. And so with the reach and economies of scale, it does make sense because startups just move so quickly. It's a really good one there. The second one, we've definitely experimented a lot and is different. It's not a technical risk. It's not a legal risk. It's a market risk, is on-chain solutions to liquidity. When I say on-chain, what I mean is assets in equity that are in paper, like contract law in paper, that are able to be traded in programmable liquidity events using smart contracts and decentralized finance, which is the world that I originally come from. And that world, one of the biggest trends, anyone who's on the call knows, is real world assets being on chain for the first time. Stablecoins is probably the first example of that being scalable and working, where you take real currencies, you make them available on chain. And the reason that exists is because smart contracts are just more flexible than contract law, right? So you can take an equity that has been produced after conversion of a safe and put it on a smart contract and allow it to trade, allow it to be sold, allow it to be financed as debt. There's quite a different solutions. One of the ones I think we're most bullish on is actually indexing startups in our ecosystem. So instead of everyone being exposed to individual companies, is actually indexing companies per thematic group. And with the volume, if it gets high enough, this happens regularly in the DeFi world. If the volume gets high enough, that smart contracts start distributing capital back to the investors that have joined that pool, essentially. That's probably one of the biggest ones where like bullish on, and we've tried to like back calculate the volumes that are possible and is significant. Is just it's such a hard change from where we are now, so it's more of a market risk than anything else. And the other one, Henry, we've talked about this before, and Caleb, you know this, stock options are not popular in our ecosystem. Out of 10 companies we onboard, like half of one has a stock option plan. I say half because they've thought about it but not implemented it. It's not popular because we don't have any liquidity, right? And until employees and contractors see the importance of owning parts of these companies, our ecosystems is just going to be completely stalled. And Henry, I know a lot of Carta's growth came because companies were issuing stock options. So finding ways of financing those is really critical. We've experimented a couple of products on chain as well, where you could distribute assets directly to a stock option pool of owners, based on the kind of asset they would own and the kind of classes that they have in the stock option. It would be able to liquidate some of those assets on a monthly basis, which is just so different from us hoping for Series A. So those are a couple of solutions. These are in on-chain world, and the traditional financial route, like Henry said, is like Daniel's merger, like you said, with Max AB and Wasoko, Caleb, private equity buying out funds, which is happening. Larger companies consolidating because there's this like consolidation phase, like we saw with Brass a couple of days ago. That like consortium of Paystack, PiggyVest, ventures platform, like consolidating a banking software, obviously means that Paystack is going to launch banking software. That is the net positive thing that will probably have a huge impact over the long term. And I guess philosophically, I'm hoping that we end up building all these things, like Henry said, or the on-chain solutions in such a way where we normalize this. So Henry, you brought this up. Volatility in other markets is probably not okay, but probably better. Volatility in the currency, macroeconomic, and the political environment that Africa is in is catastrophic. So venture asset class, like we have to think about this as like long term. How do we compound generational wealth, over 5 to 10 to 20-year periods, as opposed to invest, feast and famine, and exit? Like that model just, I don't think will work for us. I think we've seen that. So it's kind of like how do we distribute these assets or construct our instruments in such a way that we have long-term patient capital we reward, and employees, investors actually encouraged to hold for longer periods of time as opposed to selling. And Henry, the closest approximate to this philosophy is probably LTSE. It's really relevant in our ecosystem. And Caleb, I think that's some of the solutions. Some crazy ones. We're in the category of we're in the business of making new categories of software, so it doesn't feel that crazy. And then the traditional routes of PE are probably in the short, immediate term, and I think would work really well, especially in South Africa. This has been happening quite frequently recently in SA. It's a good signal.
Awesome. I want to quickly go to the audience. We have time for maybe one question from the audience, so just punch your questions in the comments, and we'll pick out one.
I might add one more idea to
please.
Marvin's, and this will sound incredibly hypocritical because I've been doing this for 11 and a half years. So I'm at almost 130 months of losing money. 11 years of losing money and counting, but I'm almost profitable. I will be next year. And the last resort for liquidity is to be profitable.
Yes.
Because when you can buy back stock, you can do dividends, you can do all that kind of stuff. But the biggest thing is once you're profitable, you can access debt. Even equity financing, but all debt financing is just a promise against future cash flows. What makes startups super hard is because they're negative cash flows. It's very hard to underwrite. Right. But once you actually flip over and you actually have positive cash flows, suddenly a whole new world of financial instruments are available to you to underwrite against. And that's why startups have such a hard time with liquidity, is because we're negative on the cash flow side. But once you move to positive cash flows, and that's why you need super robust capital markets that understand how to underwrite future cash flows, which are negative today. Right? That's the hard part of this. But once you get into positive cash flows, you don't need those high risk venture type of people that understand that. You can actually access much more conventional liquidity and financial instruments. So that coming from me, I know that's rich, but that's actually the one of the best ways to liquidity.
You're close, and yeah, it is. I just want to give an example. We have a company we're working with. We onboarded them 2 weeks ago. Incredible company. They're so close to break even and profitability. They take in debt very regularly. They're growing like very regularly, Henry. Company still has safes on the cap table. At like 6 million annual run rate in dollars. When you look at their market cap in Uganda, their headquarters, their market cap is almost the size of the market cap of the local stock exchange. And they're profitable. It's like the most insane situation. So you're right. I think being profitable is probably the number one solution. A lot of companies, ecosystem and founders, funds are encouraging it. And that's kind of like how we would build like long-term, patient, profitable capital.
Yeah.
Good one.
Yeah.
That's awesome. Like, Henry, are there financing options if you are not profitable though, to get to that state? Because there is venture debt, and there are some forms of debt that can be accessed without being profitable, right?
Yeah. Venture debt is not too different than equity, except it's more punitive. So generally speaking, venture debt is for you really only do it if you're not profitable, but you have a path to it. And you're quite confident in that path. Because again, it just doesn't make sense for anybody, for the company or the lender, if you don't have cash flow, if you're not profitable, and that's why venture capital exists. And it goes to this point, which is, I think, in venture we always have this perspective, like raise more money, and keep pushing out the profitability curve, which makes a lot of sense if you can trade profitability for growth.
Right.
We got a little bit into the thing of like, even if we're not growing, let's just raise more money, right, to push out the profitability curve. And I think the for a lot of founders, the mindset is shifting to like, hey, if I can grow at 30% or 40, I can grow at 30% and get profitable, or 40% and stay unprofitable. Why don't I go to 30% and stay profitable? And then I control my destiny. All these new instruments, financial instruments open up for me, because the thing that's hard to underwrite, it is very binary, because if you are losing money, you are default dead, right? So whoever gives you money has to not just underwrite the company, they have to underwrite your ability to raise more money. But if you're profitable, they only have to underwrite the company. They don't have to worry it's going to go to zero. And so it's, the difference between losing $1 and losing zero every month is profound. It's a huge difference in your access to capital.
Right. 100%.
That's awesome. Great insights. We'll do one question before we wrap, guys. And I think this is a good one for actually both of you to answer, depending on, like, maybe one from the US side and another from the African continent side. What revenue / EBITDA / profit multiples are you seeing exits being at? And how does this compare historically? But I think the cool spin is, how does it compare, say, across, like what you're seeing, Marvin, and then what you're seeing, Henry?
Henry, you want to give this a shot first?
Yeah, I can start. And I have my corp dev guy sitting in the office, so he's going to make sure I get it right. It's so dependent. I mean, the range is so dependent, obviously, in the industry and the business and all these things. So all the caveats that exist there. We just looked at a deal. I'll give you the high end, right? we just looked at a deal which, very good software business, kind of software services, like, sticky, growing 20% NDR, which was trading at, which I think sold at about 20x EBITDA, which is crazy, in this market. So call that, kind of 6x ish, 6 to 8x revenue on 30% EBITDA margins. And then you also see, like, sort of more normal, not, kind of normal businesses will trade at 4x revenue and, 10 to 12x EBITDA. And then the, really weaker businesses, could be, especially in transactional kind of fintech businesses, might trade at 2 to 3x, revenue. So it depends so much on the quality of the business, but that's maybe the range I can give you just directionally.
Yeah, I guess it is very tricky without knowing the revenue model and the industry. But yeah, do you want to have a crack at that, Marvin?
Yeah, for sure. It's probably even harder in our ecosystem for the reasons we talked about earlier, right? There's not a really efficient price discovery, nor is there a database that has X% of the ecosystem, so it's really hard to tell. So all the caveats there. But there's a couple of deals we've done recently that I could probably give insight into on the high and low end. We've mostly seen gross revenue because many African companies are still trying to get to profitability. That we've seen like 2 to 4x, which feels sad, but the companies are solid and dominant in the space that they're in. And most of their terms are being led by local funds, which are a bit more price sensitive, rightfully so, because I think they understand the markets that we're playing in, the macroeconomics. And we've seen up to like 10 to 12x recently on gross revenue, primarily on companies that are doing Series A transactions, so converting their safes. But by and large, the deals I think we saw the last 2 weeks, I'm giving like relevant examples because, Henry, in our ecosystem, we report deals after they've been announced, right? So you can see the issue with that. Whereas the deals that are happening currently, I guess we have some insight into. So a couple of other deals we've seen recently on the revenue the last couple of weeks has been between like 10 to 12x, depending on the industry. More asset light, the higher the multiples in the ecosystem, but we all know that barely exists. We often have assets on the ground versus asset light. So that should give a sense, Timothy. Thanks for your question. Really appreciate that.
Awesome. Guys, this has been such a fun and insightful discussion. Henry, it's been amazing to hear about your journey and how you thought about, building Carta and how you landed on eShares, now Carta, and built it to this incredible, very large company. And Marvin, always great to hear the mission and how you're thinking about, liquidity, how you're thinking about our ecosystem and where equity is. So thanks so much for those insights. What I'd just love to hear, maybe just to round out, like one from the audience. Firstly, what's one thing you learned from this? Just put it in the comments. Your biggest learning from this. Punch it in the comments so we can see what you got from this and what you found valuable. And Marvin and Henry, maybe one thing you guys learned from this experience of just talking about equity and diving into some of these alternative ideas to liquidity.
Hard for me because I learned so much from Henry all the time. I've learned that it's not too late for this robo-advisor idea, Henry. I'm sure it's in your dream somewhere. And the more important thing, I think, was that the private equity funds could play a really serious role in our ecosystem. And that's probably just a matter of structuring instruments and legals and corporate governance to enable them to buy Delaware C Corps. So that's top of mind. Thanks for that, Henry.
Yeah, thank you, Marvin. I think one thing I hadn't really thought a lot about was, I go to a lot of these emerging markets, the constraint is, I have this thesis on emerging markets that a lot of them are, the best startups are actually the ones that go deep into their region, right? So you look at Singapore, the best startups are the ones that, understand Indonesia buying pattern or fintech or, consumer behavior, right? There's stuff that's unique to the ecosystem. If they're doing generic B2B SaaS, it's very hard to compete with the United States. So that's why the first wave of startups, almost always in new regions, you see our fintech, because B2B SaaS is cross-border. It's easy to export. fintech is actually quite hard. So anything fintech, anything regulated, and then a lot of consumer behavior are what the best startups in these new markets are, because you're unique. It's, you know, it's impossible for me to compete from the United States with a fintech company in Africa. Like I just don't know anything about it. But what's interesting is Africa, unlike, you don't see this in Europe, is that if you know, you have a fintech company that's working in Kenya and then another one that's working in Nigeria, in Europe, you would tend to go like, well, there's a UK-based company and a French company, and that's what it is. But in Africa, you may be able to pull these things together, because even though it's a fractured, you know, or fragmented, I should say, continent, there's so much cross-border work that's happening, and collective, you know, African community and economic trade, that you can pull these things together and get scale across the 1 billion people in Africa, which gives you a much larger opportunity set than, you know, for example, in Singapore, you tend to win Indonesia and Malaysia and Thailand, but you don't try to pull these together as an example. And that's actually a really interesting way to think about how Africa could be a unique, the market structure in Africa could be different than market structures that I've seen in some of the other regions.
Yeah.
Yeah, for me, it was also that it's that idea of like consolidation, and I think it's a bit beyond the opportunity of exits. To me, it's actually like what I see as the next step, because I think there's so many like companies made almost in a vacuum without understanding what other companies are doing, or understanding that other companies as their competitors. But actually, like, it's really hard building here, as you would know, Marvin, and we need the best minds working on the same problems. And so I think consolidation is the next step for a lot of companies. We're going to see a lot more of that this year and in the following years. So, yeah,
totally.
Guys, thanks again so much for your time. We're going to wrap up here, but thanks, Henry and Marvin, and we hope to do this again with you soon.
Amazing.
Thanks,
Thank you, guys. So good to see you, Marvin, Caleb. Thanks, everybody.
Thank you, Henry. Take it easy, guys. Thanks, everyone, to the audience as well. Thanks for being here. Bye, guys.